Joining me now is Senior Vice President of Segal Marco, Frank Picarelli. Frank, it's always great to see you. Thanks for joining us this morning.
Hey, Jeff, it's great to see you. It's been a long time.
It has been, but we have stayed in touch. And for the audience, full disclosure, I have known Frank Picarelli for close to 18 years. We've worked together. We stay in touch. He, to me, is considered one of the OGs, one of the great consultants in the retirement industry. And I thought he could share a lot of expertise related to stable value. Frank, let's kind of get into it
Thank you
because
for that, Jeff.
stable, you're quite welcome. It's well deserved. Stable value has been a core component of defined contribution investment lineups. But in your perspective, how important is it in today's defined contribution world?
Well, clearly, it's a required asset in any core lineup that you want to have participants have an investment option for preservation of principal and capitalization. So clearly, it plays a different role in different markets. In the government world, it's driven by the insurance industry, and it's been a mainstay in governmental 457 plans. And there's different products that are out there, different way it operates in terms of disclosure of fees, declaring rates at the beginning of the periods, etc. And then there's in the corporate world, which is driven more by the mutual fund world. You don't see it as prevalent as an option. They tend to use money market funds, which are more responsive to current interest rates. So it's a different audience. Government employees, by their nature, tend to be a little more conservative. By working for a government, they tend to follow that philosophy in terms of their investments. But in terms of asset allocation, you always need a sleeve of it in your overall portfolio for
Yeah.
the protection on the ups and downs of what we see what's going on in the market.
And and Frank, I've read studies where 40% of government, and that's an area of clear expertise for you and the Segal company, 40% of assets typically in governmental 457 plans in these types of products. Let me ask you, would you mind telling us about the different types of products? Because there's at the very high level, there's different structures, right? So do you mind just kind of walking us through those structures?
Sure. There's really basically two main structures. Traditional structure is an insurance annuity, which we call a general account product. That's a product that's backed by the general assets of the insurance company. Traditionally, it doesn't disclose its fees. It's a spread product. So we may be earning 3% to the participants, and the insurance company is earning something else. Could
Mm-hmm.
be greater than that. Uh, they have basically some restrictions around the portability issues. And the key thing when evaluating those products is you really got to understand the exit strategy associated with that. And then there's the separate account products, which it was a gold rush to move more and more products from general accounts to separate accounts. And consultants were doing that more to get the exposure on fees and have fee transparency, which is, has its benefits, of course. And then the individual securities are owned by the plan. Plan sponsors have more of an active role in the oversight of those underlying securities in that portfolios. They tend to outsource it to the investment manager, but you really got to stay on top of it. A good consultant will always manage what's going on under the hood of a separate account, and their portability features are more flexible. You could transfer the securities in kind to a successor manager. But, I never see the situation in reality when I go through all of these searches. At the end of the day, the successor vendor or investment manager, they want to get everything over in cash. So
Right.
there's pluses and minuses with each product. And, you really got to understand the differences and really understand the out provisions of these products.
Yeah, really, and you hinted to this on this. the due diligence, and this is an area of strength. I know, again, you have spent, I don't want to out your age, but you have spent several, as have I. I've spent several decades, but you've spent more time in this stable value space. It's a key part of what you do. And of course, Segal Marco. How do you perform due diligence, whether it's that general account product or that separate account product? What do you need to know when you're looking under the hood, to use
Yeah.
your metaphor?
Well, I started my career many moons ago with a large insurance company, and I worked in the stable value area. So I had a very good knowledge of the basic contract provisions, the actuarial side of the product. And through the years in doing vendor search projects and working with that, it's a whole different evolution of it looking at the products. I'm very fortunate that I work for an organization that has tremendous bench strength in looking at the underlying investments under the hood. So when they look at stable value, they look at the composition of the portfolio, the manager on the fund, the credit quality of the underlying securities, so they could really rate and differentiate one investment policy from the other. It's like looking at a bond fund, okay, and looking at all of the possible bond managers. Then in defined contribution plans, especially in the government space, you need someone to wrap that separate account and looking at the wrap providers, their financial strengths, their risk-based capital to supply that guarantee. On general accounts, it's pretty much, this is the product. So, you look at that and you look at their investment policy statement that they have in place. You look at the types of securities, the underlying strategy of the manager in terms of its holdings, and you explore the contract provisions, looking at the exit provisions. Or you're going to get a book out distribution at settlement, or you're going to get installment distributions at settlement. So many times, clients, they're out there, they look for the best to give the participants the highest interest rate at the lowest possible fee. That's great. A general account may offer those features and really be more superior than a separate account product, but you have to understand the exit strategy. So my experience in the industry is working on RFPs is more contract strategies. I was just working on an RFP project. I spent more time working with the vendor on their exit strategy than really, going forward, because I knew the standard parameters of their contract. So the flexibility, the portability is really important. You don't want to get yourself locked in. So many clients are being challenged. They want to take their service provider out to bid, but they realize they're in a general account and they have this huge book to market differential, and there's a big cost involved with that in moving the plan. I'm not saying it can't be done, but a good consultant would look at that and basically, when they go out to bid, make sure that the vendor community really understands what that differential is.
Yeah.
And they're all bidding on a common assumptions across the board. So
Yeah.
they all know that. So a lot of good data, I believe, is essential. Cash flow analysis, the number of participants, the utilization, all of that to give to the actuaries so they could understand the client, the unique client relationship. Separate
Yeah.
accounts I use a
Go
lot
ahead.
in the larger plans where you have $1 billion in assets and you want to keep diversification in the portfolio. So you may have it carved out with a general account piece that may be generating a higher yield, and then diversification of having separate individual bond managers wrapped by an insurance company to give you diversification. So it's a combination. It depends on the situation, the size of the plan. But you got to look at what's the right product for the client and understanding the client needs. And that's a key factor as a consultant when you go through and evaluating it. But I'm very fortunate to have the research capabilities to really look at all of the dynamics that you would use to evaluate a stable value product, like you would look at a mutual fund.
Yeah. Well, yeah, Frank, I mean, it's certainly, I think, an underappreciated part. In a lot of cases, it makes up a significant portion or a big portion, a great proportion of the assets in a retirement plan. But I think, as you got into, you can't look at these things very superficially. You got to drill down. That's obviously an area of strength for you and Segal. Marco. Frank, we're going to have to leave it there. Always great to see you. And look, we look forward to having you back on the program again very soon, my friend.
Well, thank you for your time today, Jeff. It's always great to see you. Continue all of the great things you do in informing the investment community about their options and what's available to them.
Well, thanks for watching. And don't forget, we're back again tomorrow morning with another great expert and another great topic. You can tune in right here Monday through Sunday at 7:30 a.m. Eastern Time. And don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place, delivered directly to your email box. Check it out at our website.